What's the difference between regulated and unregulated investment funds in Luxembourg?
The main distinction lies in the level of regulation and supervision. Unregulated funds, such as holding companies or partnerships, operate without prior authorization or supervision from the CSSF. This means limited investor protection, but in return, a great deal of freedom in investment choices and strategies. These funds often include structures such as closed family funds or club deals.
Why consider unregulated funds?
Unregulated funds offer several advantages, such as lower costs and faster setup, since they don't require specific authorization. Because of this lack of supervision, maintenance fees are lower and they enjoy greater flexibility to change the fund's features without external approval.
And what are the main types of regulated funds?
These funds are aimed at sophisticated investors. It's important to distinguish between the Specialized Investment Fund, SIF, the Venture Capital Investment Company, SICAR, and the Reserved Alternative Investment Fund, RAIF. The SIF allows investment in several types of assets, while always maintaining diversification. The SICAR, on the other hand, is exclusively reserved for venture capital, but it allows for the possibility of having a single investment. Prior authorization for market entry is required for both the SICAR and the SIF. The RAIF, meanwhile, is supervised by an already authorized management company. It does not require any prior authorization, whether it is based on the SIF or SICAR regime.
How do you create a SIF or a SICAR independently?
Beyond the Articles of Association and the prospectus detailing all the fund's characteristics, you need to submit an application file to the CSSF. This process takes several months. The RAIF benefits from a faster process, as the authorized management company essentially delegates its license to it, checks, and approves the fund's compliance.
What are the advantages and considerations to keep in mind for regulated funds?
The advantages include increased investor protection through stronger governance and oversight, as well as relatively neutral taxation in Luxembourg. There is a subscription tax for the SIF, corporate income tax exemption for the SICAR, and a common absence of withholding tax. On the other hand, you have to deal with significant setup costs and time, as well as less flexibility compared to an unregulated fund.